Welcome to video 9C on special deductions. So let's do a quick agenda on this one because this is an atypical video. We're going to cover 5 items, and 3 of these are actually from a chapter that I didn't assign. But we're going to cover them in a way that I think I'm going to give you all you need. And there's even some homework problems, and I think you'll gauge by the homework problems that they're not going to be that difficult, even though all those topics can get difficult. So we're going to look at health insurance by self-employed taxpayers. We're going to look at the self-employment tax deduction, the QBI deduction or qualified business income deduction, hobby losses again, right? We referred to that in the last video. Here we go again. And then losses on business property. So really only one of these is in Chapter 9, so I dragged the others in. But they are business items, and they just ended up in an individual chapter, and there's no good reason for that. Anyway, just is what it is. So Dr. Nick is an employee of Springfield Hospital. Hospital pays Nick's health insurance premiums. In 2019, those were $12,000. So as we know, that's qualified fringe benefit. So the hospital takes a deduction for the amount it paid, and Nick excludes that amount from income.
Hi, everybody!
Hi, Dr. Nick!
Dr. Hibbert is a sole proprietor, and Dr. Hibbert owns his own practice. He's required to pay his own health insurance, which is a personal expense, and therefore is not deductible. So you can see we've got some asymmetry in the tax code the way this has been hypothetically presented. That's why there is the self-employed healthcare deduction. The idea is to try to provide some parity between the two versions here. Now, technically, it's beyond the scope of what we do in here, but Dr. Hibbert would have been able to take as an itemized deduction his medical expenses. But those would be subject to an AGI floor of 10% in 2019. And so in any event, we needed to pull that deduction out of the itemized deduction arena and put it here. And where did we put it? As a for AGI deduction. So for individuals, it comes before AGI. And that way you're not required to itemize to take it. And it's not subject to any sort of percent of AGI limitation. Okay. It is, however, limited to the amount of business income you generate. So one of the things they wanted to avoid is this opportunity to just have a very, very, very smally profitable side business and somehow manage to generate a self-employment healthcare deduction as a result. So it's limited to the amount of business income that is generated, and it's not deductible if the taxpayer is even eligible to participate in an employer-sponsored program. So that's to say, even if they don't participate in it, if they are eligible to do so, then they're not allowed to take a deduction for self-employed health care. And if you're married filing joint, that's true if your spouse is eligible as well. Okay, so our next item is self-employment tax, and admittedly, we kind of already covered this. This should look really familiar to you. This is the employment tax schedule, and we did some examples back in Module 1 of how to calculate employment taxes. So recall that the employer deducts 1/2 of these, and the employee pays, but does not deduct the other half, right? So the other half of self-employment tax withheld from a paycheck, that's just not deductible. But the employer who pays that tax is eligible to deduct it. So Carl's an employee and was 2019 wages? No, he was paid 2019 wages of $60,000. Oh my, I'm yawning. That's no good. So the employer's share is $60,000 times the 7.65%, which again is the 6.2 plus the 1.45, or $45.90. As a result, they take a business deduction for $45.90. Mo is self-employed and has business profits of $60,000. Mo is required to pay both halves of employment taxes. So $60,000 times 15.3%, $91.80. But remember, the employee's portion isn't deductible. So Mo's, under this hypothetical, would not be deductible. That's why there's a self-employment tax deduction. This is also a 4 AGI deduction, also not required to itemize. So on top of that, because 1/2 of self-employment taxes is deductible, let's see how that works out. So we have Mo, who makes $60,000 times 15.3% is $45.90. Well, but wait a second. If it's deductible, then his business profits weren't really $60,000. They're $55,410, right? Which is the 60 minus the deduction for one half of self-employment taxes. Well, wait a second. If it's 55,410, then 55,410 times 15.3% times 1/2 is 4239, which means that business profits are really 55,761. Okay, now you could iterate this over and over and over again, and eventually the iteration does converge on a number. The problem is there's no way the IRS wants to write a rule that makes a taxpayer iterate this over and over and over again. And so instead, they say, you know what? Just go ahead and take a 7.65% haircut from business profits to reflect your 1/2 of employment taxes prior to computing self-employment taxes. Okay? So instead of iterating, Mo would just take $60,000, take the 7.65% haircut by multiplying it by 92.35, because 100% minus 7.65% is 92.35%. You end up with 55,410. That's the amount subject to self-employment taxes. And so he would end up with self-employment taxes of 4239. So therefore, he would deduct the 4239. Okay, our next item is the QBI deduction. And I just present this flow chart because you can see how ridiculously complicated this thing is, right? So the qualified business income deduction is a deduction that individual taxpayers take related to their qualified business income. So this is available to non-corporate taxpayers. It is a below the line, so a from AGI deduction, but you are not required to itemize, and you may take the standard deduction. So generally speaking, the general rule for the QBI deduction is measure the taxpayer's qualified business income and multiply it by 20% and just take an artificial deduction for that amount. There's no expense that goes out. There's no cash that needs to be paid. It's simply an artificial deduction against that income. Okay, that flow-through income can come from a partnership, an S-corp, a sole proprietorship, an LLC, etc. Okay, so what is qualified business income? That's the net amount of qualified items of income, gain, deduction, and loss related to any qualified trade or business of a taxpayer in the U.S. So it doesn't include any foreign income. It also excludes short-term capital gains, short-term capital losses, long-term capital gains, and long-term capital losses. So all of your capital gains and losses are swept out. Dividend income is swept out. And interest income, other than interest that could probably be allocated to a trade or business, is also swept out. So they're trying to keep forms of portfolio income out. Whoops, sorry. I was getting the dust off my keyboard. They're trying to keep forms of portfolio income out of the QBI calculation. Amounts received from annuities, which we didn't really cover those, but they're excluded. And any deduction or loss that would be allocated to those items is also not allowed to be deducted for QBI. Okay, so there is a limit that applies to the QBI deduction, and it cannot exceed 20% of the taxpayer's taxable income, excluding net capital gains. All right, so in 2019, Linda operates a small accounting business. It generates $60,000 of QBI. She also operates a separate business that focuses on providing cryptocurrency investment advice. That business lost $20,000. Both of these are sole proprietorships and therefore eligible for the QBI deduction. So Linda computes her QBI deduction for her businesses, not just the accounting business, as $40,000. So that's the net of the 60 minus the 20 times 20%. That's $8,000. Now, Linda also earned $5,000 in net capital gains, but she had no other forms of income and simply elects the standard deduction. So in 2019, Linda's taxable income would be $27,800. So that's her $40,000 of business income, less her standard deduction in 2019 of $12,200. And we do not consider the capital gains. As a result, her taxable income is $27,800. We would subject that to 20%. It's $5,560. Therefore, her QBI deduction is the lesser of those two, right? It's either $8,000 or $5,560. Therefore, it is $5,560. Okay, so I only bring this up because, you just can't get enough QBI flowcharts. So here's another one. So there are two additional limitations on the QBI deduction. The first is the wage limitation, and the second is the specified service business limitation. Now, these only apply to taxpayers that have taxable income in excess of a threshold amount. In 2019, those threshold amounts are $321,400 for married filing joint and $160,700 for all other taxpayers. And yes, those threshold amounts are indexed for inflation. And they, of course, are computed before considering the QBI deduction. Okay, so let's talk about the wage limit. The wage limit is 50% of the share of W-2 wages that are allocated to that business, or 25% of the wages plus 2.5% of the unadjusted basis of all qualified property associated with that business. So you can see what they've done is created a limitation that says, wait a second, we're not going to give this to you unless you're generating jobs. And the way we're going to determine whether you're generating jobs is limit your deduction to 50% of your W-2 wages. And if you're not creating jobs, you better be investing in capital. And so the second limit is 25% of wages plus 2.5% of the property you're investing in the business. So W-2 wages are pretty straightforward. That's just wages paid to employees, including deferrals into 401k plans and the like. Qualified property is defined as tangible property subject to depreciation. So, for example, that's not inventory or land, for which the depreciable period has not yet ended before the close of the taxable year. And that property was used at any point during the year in the production of QBI. All right, so what is a depreciation period? Because it's not what you would think. So the depreciation period is defined as starting when the property was placed in service, and it ends on the later of 10 years or the last day in the last year of the property's regular depreciation schedule. So we don't really do depreciation until Chapter 10. So I don't want to really dig in too deeply on this part of the QBI deduction. So we're just going to skip this slide, but I'll leave it there for you if you really want to take a look. Okay, so the QBI deduction is subject to a phase out up to an excess of $100,000 for married filing joint and $50,000 for all others. So, for example, recall that the limitations didn't start applying until income hit $321,400. So would that mean that if you got to $321,401, you don't get any QBI deduction? Well, of course not. There's a phase out, and this phase out is completely funky. So again, I'm not going to hold you guys responsible for calculating the phase out, but here are slides and some examples, and of course the lecture slides are posted, that you can look at if you want to walk through the calculation on your own. We cover that in 503. Okay, so our next limitation we touched on before has to do with hobbies. And so the question was, are you in a business or not? And kind of by default, corporations are considered to be in business. I mean, it's not always true, but it generally is. What about other types of businesses? Well, you have to be engaged in the activity for a profit, which means you're not a hobby. So recall that hobby expenses are limited. In fact, they're not deductible except for cost of goods sold. So how do you determine whether you're a hobby or not? And generally that classification depends on the amount of time spent on the activity. So Donald owns a large number of commercial properties. For example, he owns hotels, golf courses, office buildings, etc. He spends most of his time working on those activities, and he derives the bulk of his income from them. So that sounds like a trade or business. Jared is an employee in Donald's business. Now, most of the time, and most of his income is earned as an employee. But it just so happens he also owns a vacation home on the Jersey Shore that he rents out during the summer. He has a management company handle the rentals and the cleaning and these other things. Well, that doesn't rise to the level of a trade or business. That's for the production of income. Don Jr. is also an employee in Donald's business, but he spends some time managing his trust fund portfolio. Now, he doesn't manage anyone else's investments. He just spends time using his own. So does that rise to the level of trade or business or production of income? And chances are the answer is no. It's probably just a hobby. So here are the variables that you would consider when you're trying to determine if something is a hobby. So the manner in which the taxpayer carries on the activity. Were they an expert in that activity before they got engaged in it? What is the amount of time and effort they devote towards that activity? Do they have some expectation of appreciation in the assets related to that activity? What has their track record been with respect to engaging in that sort of activity? Have they generated prior income or losses from that activity? What's the amount of that income to the extent they've generated it? What's their financial status, right? Is the profit motive a substantial source of their income, or is it just something that makes a little money and doesn't really matter? And what are the elements of personal pleasure or recreation that can be derived from that activity? So you would consider all of those items to try to determine whether you're engaged in trade or business or for production of income, or is it simply just a hobby? Now, in order for taxpayers to have some ability to determine what they think their situation is, there's a safe harbor. And that safe harbor says that if an activity has generated profit in at least 3 of the 5 years ending with the tax year in question, the presumption is that is a trade or business or for the production of income. Now, there's a small exception if it relates to horse racing, breeding, or showing. Now, if you meet that safe harbor, that doesn't guarantee avoiding hobby treatment. But what it does is it shifts the burden of proof that that is not a trade or business to the IRS. So they would now have to go in on a fact-finding mission and try to prove that you are not a trade or business. And that is a much higher threshold, a much higher hurdle for them. And so they are less likely to do so. If you don't meet the safe harbor, that doesn't necessarily mean you're condemned to hobby status. So let's take, for example, something like Facebook, right? So at some point, Mark Zuckerberg was operating Facebook, and it operated at a loss for years. Does that mean because it didn't meet the safe harbor, it was a hobby? Well, maybe very early on it was a hobby, but very quickly it turned into something he devoted a massive amount of time in. And so as a result, he would have to go through those variables that we just discussed and show that he really is a trade or business. So Ned's engaged in an activity that sells left-handed merchandise to customers. In 2019, Ned generated $3,000 of income, had $2,000 of cost of goods sold, and $2,100 of other expenses related to that activity. So what would Ned report if the activity is a trade or business, a production of income, or a hobby? Well, if it's trade or business or for the production of income, Ned can deduct all of expenses, and he would end up with an $1,100 loss. Now, note that there's no self-employment tax because there's a loss. And remember, self-employment taxes are based on 92.35% of your business profits. That loss is also likely to be deductible. Now, individuals have an NOL process that they go through that's pretty funky that we don't cover in here, but the likelihood is he's going to be able to deduct his loss. If, on the other hand, it's a hobby, then what happens is Ned reports $1,000 of hobby income. Recall that's his $3,000 of gross income minus the $2,000 of cost of goods sold, but then he's not eligible to deduct any other expenses. Note that there is no self-employment tax on hobby income. So the reality is, if you run a side business and it's really only moderately profitable, you're actually better off treating it as a hobby because you pay income tax regardless, but you don't pay any self-employment tax. Okay. So our next special business deduction relates to business property losses. So Barney sells his personal car. He generates a $4,000 loss. That's probably a capital loss. It's a personal loss, and it is entirely not deductible. Krusty sells his business auto, generates a $4,000 loss. This is probably not a capital loss because recall, under Section 1221, trade or business property is on the not list, which means it's an ordinary asset. Business losses are generally deductible. And that's really it, right? So when you think about it, the reason we draw this out or draw your attention to the fact that business property losses are different is that they're largely deductible, whereas personal losses are largely limited. So a business casualty loss is also deductible, but the amount of that loss can be measured differently depending on the circumstances. So let's think about our typical rule. When we have a sale, exchange, or a disposition like a casualty, that means we go to amount realized minus adjusted basis equals our realized gain or loss.
Learn it, know it, live it.
And in a casualty, the amount realized is whatever the insurance proceeds are, if there are any, or zero if it's uninsured. But what if the property is not completely destroyed? So let's look at an example. A business auto is in an accident. An adjusted basis at the time of the wreck is $11,000. But the car's not totaled. It simply requires $3,000 worth of repairs to fix. And then it's off to go. We're just assuming that it's below the deductible so that we can simplify assumptions around insurance reimbursements. Okay, so the amount realized is zero. If we backed out the adjusted basis, there'd be an $11,000 loss. But really, think about it. That doesn't make sense. The car is back operating, right? It's back being used by the business. So why would we reduce its adjusted basis all the way down to zero? And we wouldn't. So when a business has a partial casualty loss, the loss is equal to the lesser of the decline in the fair market value of the property or the adjusted basis. Okay, now let's go look at that example again. Recall the adjusted basis of the auto was $11,000. What was the decline in the fair market value? Okay, well, even though the rule is written with good purpose, it's very hard to know pre and post what the fair market value of that auto was, right? So did you keep fair market value before the auto was damaged? Well, no. Do you know the fair market value after the auto was damaged? Well, not really. So one of the things that's pretty popular with taxpayers is the cost to repair the auto is probably a pretty reasonable estimate of the decrease in the fair market value. So, and the tax law is written with some safe harbors around being able to use that exact number. So we can go ahead and assume that the decrease in the fair market value was $3,000. So the casualty loss is $3,000. Note that all personal casualty losses are subject to this same lesser of rule. So whether it's partially destroyed or completely destroyed, a personal casualty loss is subject to this rule. They're also restricted in many, many, many other ways. So again, we saw that with business losses versus personal losses, whether they were casualties or not. You see the same thing with casualties, which is the rules are much more expansive if it's associated with a business. That brings us to the end of video 9C. Thanks for watching.
Now, there are many options available for dangerously underweight individuals like yourself. I recommend a slow, steady gorging process combined with acyl horizontology.
Of course.
You'll want to focus on the neglected food groups, such as the whipped group, the congealed group, and the chocotastic.
What can I do to speed the whole thing up, Doctor?
Be creative. Instead of making sandwiches with bread, use Pop-Tarts. Instead of chewing gum, chew bacon.
You could brush your teeth with milkshakes.
Hey, did you go to Hollywood Upstairs Medical College too? And remember, if you're not sure about something, rub it against a piece of paper. If the paper turns clear, it's your window to weight gain. Bye-bye, everybody!